What's going on, guys? Welcome back to the channel. My name is Mark and this is 360 Finance. In today's video, we're going to be going through one of my favorite Warren Buffett clips of all time. And if you guys enjoyed this clip and you learned something from it, this is definitely a series that I can continue on this channel, classic Warren Buffett clips, we can call it, or something, or famous Warren Buffett clips. We're going to be talking about something that is implied in this video, and it's talking about how long stocks can, remain overpriced, if at all, right? And it kind of implies this quote from John Maynard Keynes, the famous economist, about how the market can stay irrational longer than you can stay solvent. So that being said, the S&P 500 is well above 4,000 right now, the first time it's ever been this high in history. And how long do you think it can last? Okay, so let's go ahead and jump into the clip, and I'll give you guys my interpretation after the video.
So GDP per capita in the 20th century in the United States went up 610%. Actually, qualitatively, it went up far more than that, because you can't really measure certain things in medicine or whatever it may be, and improvements. But just on a quantitative basis, it went up every single decade, including the decade of the 30s. So here you had 100 years when basically the U.S. citizenry was improving their lot decade by decade by decade. The 30s, it was up 13%. Best decade was World War II. The 40s, it's up 36%. The worst decade was the First World War. So you get sometimes the analogy, you can get in trouble on analogies. But in any event, it was a huge period. Interestingly enough, there were 6 big periods in there for the stock market in both directions. There were 3 big bull markets. From 1900 to 1921, the Dow went from 66 to 71, less than a 10% move in 20 years, less than 0.5% a year. You got dividends too, but 0.5%. So it didn't move. From 21 to 29, as you point out, it went from 71 to a high of 381 in September of 1929. Went up 500%. Well, obviously, the well-being of the country didn't go up 500% during that period, and the well-being of the country went up a whole lot more than 10% during that first 21 years. So you got this very uneven development. Then from September 1929 until the end of 1948, the Dow went from 381 to about 180. It was cut in half. And that was 18 long years. And yet the per capita GDP was moving right up during this whole period. So the economy was doing fine. From 48 to 65, the Dow went again from about 180 up to close to 1,000. Again, 5 for 1, which was far outstripping it. From 65 to 81, the Dow went down, literally. Well, again, per capita GDP. And then we've had this last period where it's gone up terrifically. If you take the whole 100 years, it went up 180 for 1. Every $1,000 became 180,000. But 43 and 3/4 years were those 3 big, huge bull markets, and 56 and 1/4 years were periods of stagnation, all in an economy that was doing fine, year after year after year. 56 and 1/4 years, net, the Dow was down a couple hundred points during that period, and the other 43 and 3/4 years made up the rest of this move from 66 to 11,000 some on the Dow. So you say to yourself, how could it be that you could have a country that was doing better and better and better and better? Citizens were living, every generation was living better than the one that preceded it. But you had these huge changes, big gains a few times, long periods of stagnation. 20 years, that's a long time to do nothing. The answer is that investors behave in very human ways, which is they get very excited during bull markets, and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity. Just huge opportunity. I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 48, from 65 to 82, 17 years. I wrote an article for Forbes in 1979 I just said, how can this be? Pension funds in 1970 put 100 and some percent of their new money in stock because they were wild about stocks. Then they got a lot cheaper, and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of the reactions because they're human beings, and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful, and they'll continue to do so. And you will see things you won't believe in your lifetime, and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains. It takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. I started selling securities when I was 21, and a Kansas City life insurance company happened to be a fairly prominent company in Omaha, and the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35% if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. I mean, he's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. I said, Mr. Moose, I said, you're selling these policies with 2%. You may even have a few members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, a 2% investment on, and you can get 35% on your money. And he said, stocks aren't any good. And I couldn't sell you, I was a lousy salesman. I mean, well, you have to start with that, but it just blew me away. It blew me away. I thought, sometimes I used to wonder if I was nuts, but those things, the same thing happened. I mean, in 1964, the Dow closed at 864. At the end of 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move. And that, you can't believe how discouraged people were during that period. But, people were living better. So things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty, but think about that. And particularly think about it next time you're trying to do something just because the stock's gone up a whole lot, and your neighbors made money or something. You've got to be, you just have to sit and think objectively and think about, would I buy this whole business? If it's an internet company that's got 100 million shares out and selling at 100, that's $10 billion. Is it worth $10 billion? If it's worth $10 billion, it's got to be able to give you, 700 or 800 million next year. And if it doesn't give you 700 or 800 million next year, it has to give you maybe 10% more than that the year after and continue to. There aren't a lot of businesses that can do that. And people just go crazy. And of course, it's fun. I mean, it's like that sign they put in brokerage offices that says, avoid hangovers, stay drunk. It's just so much fun to keep playing. But you got to do sensible things to get good results.
Okay, so that's the clip, and we're going to talk about some of the main lessons that he discusses in this video. The first one being basically to remain invested for the long term. The first thing he mentioned is that over the last 100 years, the Dow Jones returned, if you invested $1, 180 to 1. Okay, so that means if you invested $1, it would be worth $180 today. Just important to, again, stay invested for the long term and focus on building wealth through these good companies that are generating very positive earnings, recurring earnings, and are likely to be here for the long term. Because in the short term, the market is a voting machine, but in the long run, the market is a weighing machine. One of my favorite quotes. The second lesson that he kind of talks about is human psychology. And he talks about this, how during these bull markets, these periods, that people exhibit very natural human behavior. In bear markets, people are obviously so scared to invest their money because they feel like they're just going to lose it. There's 20-year periods in the Dow Jones history where it returned less than 1% a year. Okay, so obviously over those periods you're much less likely to want to invest your money because you see terrible returns. And the opposite in bull markets, where investors get too excited and valuations get way too frothy and too high basically. And when you see the stock market going up, you get FOMO, the fear of missing out, and you just put all your money in the market as well because you don't want to miss out on these incredible gains. This is natural human tendency, and this is kind of where the famous Buffett quote came. Be fearful when others are greedy, and greedy when others are fearful, because you have that contrarian view. You don't want to be doing what the herd is doing, because that's bound to change at one point or another, and you want to be ahead of the herd. You don't want to be in the herd, you want to be ahead of the herd. Don't just be getting into the stock market because your neighbor is making money. Don't just be getting into, let's say, like REITs just because your neighbor is making money on REITs, or be someone on the internet told you that the REITs are a good investment. Do your own research. Make sure to factor in that what humans will do with money. Human psychology is so important when you are investing. And one of the things he said there, it really doesn't take brains to be good at investing. What it takes is temperament. And just detach yourself emotionally from what the crowd is doing and just focus on investing in these good, profitable, recurring earnings, positive cash flow businesses that have high value. The third lesson that he kind of talks about in there is interest rates, and we can make a whole other video on interest rates here, but essentially when interest rates are so low, he's said recently in the past couple years that stocks are incredibly cheap at the level that these interest rates are at right now. And the reason being is when interest rates are so low, that means that the guaranteed return on bonds and debt maturities is so low that you're just pushed out of the bond market. You don't want to be earning 0.25% on a 3-5 year bond when you could just speculate in the stock market and make 30 times that. Okay, so interest rates are pretty much at an all-time low, and they can only really go up from here unless North America kind of takes a ECB, European Central Bank route, and goes negative rates. I think that actually has potential to happen in the near future, but that's again a whole nother video. But with interest rates so low, there's tons of money just piling into the stock market and out of the bond market, right? And stocks are extremely cheap in these low interest rate environments. And interest rates have a direct impact on stock valuations, meaning when interest rates go up, the value of stocks should go down, and it will. And when interest rates go down, stock valuations become way more attractive. At the end of the day, the purpose of this video was to address one thing, and that was that the market can stay irrational longer than you can stay solvent. Basically what I'm saying here is, if any of you follow Michael Burry and follow him on Twitter, or just any people making videos about him on YouTube, he's been saying the market's going to crash for a long time now, and like over a year, and even after the COVID bubble, and he's still maintaining today that this is the greatest speculative asset bubble of all time, which it very well may be. But to me, the bubble is more so on the crypto side than it is on the stock side. But if there's anything you learned from today's video, I hope it is that just detach yourself emotionally from investments. Don't worry about what the crowd is doing, and do your own research. And that's how you will be the most successful at investing, is by using your temperament and not your brains. Obviously, using your brains with temperament, it will probably maximize results even better. But hope you guys enjoyed today's video. That's one of my favorite clips of Warren Buffett. If you guys do really enjoy this video, don't forget to smash the like button, as I will absolutely upload more gem Warren Buffett videos in the future if you guys enjoy it. Hope you guys got value out of this video, and I'll see you guys in the next one. Peace!